Welcome to The Exchange. I'm Anthony Curry. Rob Cox is off gallivanting around Asia for a couple of weeks. Today on The Exchange, we're talking about the rise of artificial intelligence trading on Wall Street. My guest is Scott Patterson, who is a reporter with the Wall Street Journal and the author of the book Dark Pools, High-Speed Traders, AI Bandits and the Threat to the Global Financial System. Now, Scott, if I sort of step back from this 25-year history or so you're giving of stock traders and how they're getting into electronic trading, what I find is that it really is just about one great big game of one-upmanship from the beginnings in the 80s, where traders were just really annoyed at the inefficiencies of the exchanges. And now we get to a situation where things like the flash crash happened 2 years ago, where the stock market's just basically crater in a matter of seconds. And how did we get to that point, and why are people so determined to have better and better machines?
Right, well, it's a long story. It's taken over a few decades. The issue now is that this game of one-upmanship has reached totally absurd levels. These guys are measuring trades at time frames around a trillionth of a second. So a good example of this is a company called Spread Networks, which has just built a fiber optic cable between New York and Chicago. They spent $300 million on this cable.
Just on the cable?
Just on the cable. And the intent of this cable is to shave 3 milliseconds off the time it takes for a signal to travel between New York and Chicago.
That's incredible. So has that given them a great advantage?
Well, it worked okay for about a year or so, but now new firms are using microwave technology to shave further time off the amount of time it takes to send a signal. So this $300 million investment this company made is actually not worth much anymore.
Mm-hmm. What does it mean for the average investor? Well, I mean, let's start maybe with an institutional investor. I think who we're talking about at the moment are high-frequency traders. What if you're a Putnam or someone? What effect does this have on your ability to buy and sell?
Right. Well, I think it kind of shows how the market has evolved into something that doesn't have anything to do with those investors anymore. It's all about this huge electronic arms race that these firms are engaged in. And the regular investor is just sort of a sideshow. The exchanges don't really care about them. They want them to be there because, in a way, that's sort of like the food that these firms feed on.
Yeah. I mean, the exchanges for years were getting knocked by the broker-dealers, the Goldman Sachses, the Morgan Stanleys of this world, who were coming up with their own trading platforms internally. And now they get a chance to hit back. But it's fine. Their volumes aren't brilliant, but they're better than they would have been if they hadn't done this. But it means they now rely on these high-frequency traders, doesn't it? Aren't they almost in bed with the devil? Right.
Well, yeah, sure. They want everybody to come to their exchanges, the New York Stock Exchange, NASDAQ. They all want everybody to come there. The problem is they've been forced to cater to this one group of trading firms because all the exchanges are competing against one another to get these firms to send them their flow. So they've given all the advantages to these firms. The mutual funds are getting wiped out now. I've talked to mutual fund traders and hedge fund traders, and they're just going crazy. They're pulling their hair out because they can't get a good trade on. They're always getting front run, or their order just won't get executed.
Well, front running, I mean, that's got to get the regulators involved. And surely the regulators are, I hate to ask this, surely they must be all over it.
I hear that they're trying. It's very complicated, and there's a difference between statistical front running and real, illegal front running.
Right.
So these firms can argue that they're just smart. We've statistically been able to figure out that a big order is coming, so yeah, we're going to move our price.
Right.
But there's also some practices that the regulators are looking at. The exchanges are giving these firms the ability to use, special order types or data feeds to actually jump in front of
yeah, that was one of the things you had in your book, where one of the high-frequency traders you talked to on the options market, where he was getting killed, in 2009, 2010, his new firm, and he spoke to an exchange official at a party who said, well, actually, there are these new order flows which allows certain traders we want to come in to get ahead of everyone else, which is basically the exchange giving a better way of getting orders through than to some clients rather than others, which surely isn't their job.
Well, it's, like I said, it's all about attracting that high-frequency flow. So they design these order types. When you actually look at how these things work, you're just dumbfounded, because why would they do that? These order types work in insane ways. They're invisible. They light up when an order is executed. It's just completely insane, and it's all about attracting that flow. And the exchanges will say, well, we published how these things work. So what's the problem?
Yeah, well, you can publish things and you can make it clear that things work
right.
certain ways.
You can have a conversation with somebody like having in this party and say, well, actually, here's the tip-off. You actually should do this.
So what happens next? I mean, I think just the other day the SEC came out with some recommendations in the wake of the flash crash more than 2 years ago. So clearly things aren't going quickly here. How can we stop this happening?
Well, that's a good question. I think that it's at this point, it's kind of like it's out of control. I don't know if there is a way to stop it.
But you've got some people in the industry, Thomas Petterfee at Interactive Brokers, and the chaps at Credit Suisse who were the first ones to come up with some of these really, really fast technological platforms. They're now standing up and saying, actually, this is getting out of hand.
Yeah. Even the pioneers of electronic trading are saying this is just completely crazy. But how do you stop it? I think that what the SEC needs to do is to give people reassurance that they're actually watching what's going on. Right now, believe it or not, the SEC has no idea about a huge amount of the trading on the U.S. stock market.
Which seems ridiculous. If so much of it's done electronically, then it should all be captured pretty easily, and getting it from the firms involved should be relatively simple, you'd think.
Yeah, you'd think that, but the SEC has really been slow to move, but actually just yesterday they did approve a so-called consolidated audit trail, or the CAT as they call it, which should give them the ability to monitor a large amount of trading. There's some concerns that it's been watered down.
Right.
A few of the commissioners didn't vote for it. They said that this isn't really what we want. So it remains to be seen if they're actually going to do something that is effective.
And as you were mentioning earlier, firms are still out there sort of running amok out there, getting new technology platforms out there. And this week we've seen one deal and another deal rumoured. So one of the exchanges here, Direct Edge, is rumoured to be in talks with the Toronto exchange, right?
Right, TMX.
So clearly the exchanges still really, really crave having this order flow.
Right. Well, Direct Edge is a perfect example of this evolution. They were created in 2005 as an all-electronic firm to basically cater to this new breed of computer trader. The TMX, the Canadian exchange, they've been really kind of trying to figure out a way to get into the U.S. market, which is just massively bigger than Canada, and it gives Direct Edge a way to get into Canada. The thing is, Direct Edge is currently the subject of a probe by the SEC that we've written about in the Wall Street Journal into, guess what, order types.
Yeah. So what happens in other markets? The other deal this week was Reuters buying FXall, a foreign exchange trading platform. And we've seen Goldman Sachs, BlackRock, and several others saying, we're going to set up bond trading platforms, electronic platforms. We're going to have artificial intelligence in there. We're going to have algorithms in there. These markets, certainly foreign exchange is relatively liquid in some areas, but bond markets are really quite illiquid. So this could help. But again, do you think it would go through the same kind of life cycle and perhaps more quickly as we've seen in the stock exchange?
Oh, absolutely. That's what I'm saying is you can't stop this. This is just it's a revolution in technology. It's good, it's bad. There's, my thing is the regulators need to be on top of this. And forget bonds. Think about derivatives. Think about credit default swaps.
Right.
With Dodd-Frank, the government is pushing a whole lot of this derivative trading onto electronic platforms.
Yeah.
So soon you're going to have high-frequency AI trading systems swapping credit default swaps on electronic platforms.
And we've already seen what disasters in derivatives can do without that kind of kind of platform.
So think about a flash crash in credit default swaps.
Well, that's all the time we have. Scott, thanks very much for coming in.
Thanks for having me.
I'm Anthony Curry. Join us again soon for another episode of The Exchange.